And Chris Kerlow, who's been on the desk with me. These stocks, are they ones that you own, first of all, but they're also from sectors that people have been looking to and deciding, is now the time? Because they've got the dividend yield, they've got the lower valuations. How do you think about that?
Yeah, we were looking at them really closely back late last year when the Canadian dollar was strengthening against the U.S. dollar and repatriated some assets. The play there really is interest rate sensitivity. These stocks, really underperformed their U.S. peers during the rise in bond yields last year. We've seen them starting to bounce back. You saw that Rogers chart. These are long, predictable cash flows. Obviously, Rogers is an oligopoly in our industry. We own Bell and Telus, the two other major players in the space, more West Coast focused, a little more business focused on the recovery there. But obviously look through these earnings to see what we're going to see from those two. And
on the REIT side, have you been dabbling there?
Yeah, we have some REIT exposure in the LWC Canadian Dividend Fund. We own RioCan. Super cautious on the commercial space as well. We could see a higher for longer interest rate environment, echoed by Jerome Powell yesterday, the Bank of Canada the week before, kind of taking the March rate cuts off the table. But longer term mortgage rates, bond yields have come down, which is a reprieve for those companies that are obviously highly levered and facing some challenges here today.
We're watching a sell-off happen in real time right now in the regional banks. And I would say yesterday the market was kind of stoic about what was going on with New York Community Bank because it thought, well, maybe that's a one-off. But as Andy Bell mentioned, then you have this Japanese bank also warn about its exposure and losses tied to U.S. commercial real estate. And so now the pain points on the S&P 500, we're taking a look at it. All of them are getting clipped again. This comes one day, as you said, the Fed says, we're not going to cut yet. Is the setup getting a little bit SVB, March 2023?
Yeah, think back to March 2023. We added actually to the money center banks. As Andy mentioned, the exposure they have on their overall loan book is much smaller. They got thrown out with the baby in the bathwater there. We didn't see it as a systemic risk throughout the banking sector. I think some of these regionals, much like SVB, that are very narrow focused on specific, particularly in the commercial office real estate lending, is areas of caution. I don't think I would be dipping my toe in yet. I still think the rate cut expectations on the dot plot and on our Bloomberg terminals is still too high and probably needs to come down.
Our bank stocks are getting clipped as well right now, both the insurance but also the bank stocks. Part of that could have to do with this. We're seeing a sharp rally in the bond market as well, but you've got kind of this double thing, right? The rally in the bond market and potential fears. Would you buy the Canadian banks on weakness here? How do you think about them as a sector?
Yeah, the Canadian banks have underperformed over the past 12 months, relatively speaking, when you look across the spectrum. We own TD and BNS. You need to kind of have exposure. It's just such a 25% of our index here in Canada. The negatively amortizing mortgages are a concern for us. Scotia is one of the lowest in that sector. The Bank of Canada probably has a little bit more leeway than the Fed. Their mandate is, a 1% to 3% inflation band. We're getting close to that top edge. They don't have that dual mandate of the employment side. It's really hard for Jerome to go out and say, we need to cut rates with how strong this labor market is. We don't have that same thing here. So I think that the Bank of Canada does have some firepower to come in and kind of provide a little fuel to the economy if necessary.
Okay, so as we focus on that weakness in financials, the last time we had sort of this crisis, that was a real reason to get back into tech, right? In March last year, we saw tech stocks do incredibly well. Those became the safe havens. Cut to today, we've advanced way more than where we were in March of 2023. Was yesterday and the reaction to those earnings, you think, a little bit of a hiccup, a knee jerk, or do you think we're kind of ripe for a pullback in the tech and specifically those large cap names?
I think it's idiosyncratic based on the names. We have three big ones reporting today: Apple, Amazon, Meta, Google yesterday. It's all mixed earnings. We're picking away. We actually added some Tesla on the weakness after their report. Elon came out, with a bigger CapEx spend.
You added Tesla.
We added two Tesla. We were hoping that the last quarter was the washout. Unfortunately not. So added a bit there. Few things, obviously their share in China continues to slide. He announced a $10 billion spend. Street was expecting $8. he's proven to be one of the best allocators of capital in the world. We're okay with that. And we think really it is their network effect. They'll probably have 18 million active users in the next 5 years at paying a couple $100 a year. We think that's about half the value of the stock.
So all those things about his pay package and that, as an investor, where do you put that? Noise or worth looking at?
It's worth looking at, but I think, we're focused longer term. We don't look at like the day-to-day gyrations. Last time I was here, Andy was talking about a steering wheel falling off on one car. I mean, they have, millions of vehicles on the road. You're talking about one of the best allocators of capital in history. And you add to that, they just signed Subaru and Toyota to allow them to use their charging stations. They have that network effect, their energy storage, a bunch of ancillary businesses that should provide some growth longer term.
And out of the Magnificent Seven, I know you say you got to kind of choose your spots. Is that a high conviction idea?
Yeah, it's a high conviction idea for us. I was looking at some earnings coming into this. Facebook seems pretty interesting. They've been kind of the top performer of the group in the last month or so. Online ad spend grew about 8% last year. They did 15. It's expected on average to go about 12.5 this year. Wouldn't be surprised if they do 20. And I think Zuck's going to probably give back, $90 billion plus in share repurchases to shareholders this year. So, if, that's one that on weakness we would take a closer look at. Apple probably the least attractive of those Mag 7. They report today. Still weaknesses in China despite selling 3.2 million phones last year. Another big share repurchase program coming out of them, but I wouldn't be adding at this point.
All right.